Guys, in the last video, we talked about trend reversals. Today, we're talking about trend continuations. After all, everybody and their mother on YouTube says the trend is your friend until the end. Whatever the hell that even means. Freaking nerds. Anyways, we're talking about how can we exploit this friend is the end until whatever they say. Well, we can do so with something called hidden divergences. Now, there are hidden bull divs and there are hidden bear divs, just like there are normal bull divs and normal bear divs. If you didn't go watch my last video, go watch it because it's important. However, it is vital that you do not mix the two up because hidden divergences are a lot different than regular divergences and they will get you wrecked if you read them incorrectly. Okay, so watch this back a couple times if you need to, but let's talk about it. As we know from the last video, a regular bearish divergence is when price is making a higher high and your oscillator is making a lower high. Wow, that is really the ugliest thing I've ever drawn, literally in my entire life. Right? That is your regular bearish divergence, and this is how you find trend reversals. Now, what is a hidden divergence? Well, it is still when price is doing the opposite of your oscillator. However, it is when price, we're using the bearish example, it is when price is making a lower high. However, your oscillator is making a higher high. Okay? This is important because this is going to get you the continuation for a downtrend in this case. Okay? Now, they don't explain why. No one ever explains why things work. They just tell you that it works and expect you to learn, even though they are retail and 95% of retail loses. So why would you learn from a loser? But anyways, I digress. This is how I want you guys to look at these waves. By the way, this indicator on the bottom is called Market Cipher B. I have a complete video tutorial on it. Go check it out if you haven't already. Affiliate link is down below. All right. This is how I want you guys to approach these waves. We have our oversold, which is this negative 60 line, and we have our overbought, which is our positive 60 line. Now, as you can see on the 2-hour time frame, we are currently overbought, right? When you're in overbought territory, you're looking for regular divergences. We are not looking for hidden bullish divergences up here. No, 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 no. We are looking for hidden bullish divergences when we're down here. Okay? Now, I want you to look at this oscillator, and I want you to think of a trampoline. Let me actually make it bigger so you guys can see it nice and juicy. All right? I want you to think of a trampoline. We're going to flip to bull mode right now, okay? Pretend we're looking for bullish entries. Pretend you didn't get in on this move, right? We're on an uptrend now. You didn't get in, what do? I want you to think of a trampoline. When your wave comes all the way down here, right? Let's just say to this 60 line, you have more room and more time to bounce upwards, right? If the wave comes all the way down here, hypothetically, it can come all the way up here, 200% or whatever, theoretically, without any like real issues, without any real resistance or whatever the case is, right? Now, I want you to think of a trampoline because the higher you jump on a trampoline, the higher the bounce, right? So if the wave clips down here, and you jumped from up here, when you bounce higher than if you were to jump from here. You won't bounce as high. This is an important concept to understand, and this is important to think about when you're looking for hidden divergences. Let's draw an example on what could happen. Okay. We already know that a hidden divergence is when price makes a higher high, but your oscillator is making a lower low. So let's draw it out. We have some green vectors here, so we can't be surprised if price comes below. If you have no idea what I just said, go and watch my videos. This is probably the most important video, is the vector candle video. And let's say we get a bounce from here. However, let's just say it takes us some time to get there. And this does something like this. Okay? So let's get our trend line tool. We have a higher high, but our oscillator, we have a lower low. This is a hidden bullish divergence. And as you can see, if we get our green dot right over here, right, X marks the spot, then we have this much room to move up in terms of overbought and oversold. So if price has failed to make a lower low, but your momentum made a lower low, now we have more room to ride up. And this is how your trend continuations are formed. This is how you can spot them, right? You can draw your trend line and whatever. You guys know I'm not a big advocate of that and the geometry shapes. I follow the money. But that's the premise of your hidden divergences. Now, there's a couple things to note about your hidden divs, okay? Number one, I find that they work best on the higher term time frames. You're not going to catch the exact bottom of a trend continuation with hidden bull divs, okay? That's more so for regular bull divs. Because your hidden bull divs, you're looking at the overall trend. Right now, we're trending upwards. So when price starts to get down here, if it comes down here, we're looking for hidden bull divs on the higher term time frames. When you jump down to the lower term time frames, actually, let me keep this on, right? So let's just say this happens. On the higher term time frames, this is what we're looking for. However, if we jump down to the 12, for example, which could be our execution time frame, by the time we get down here, you're not looking for hidden bull divs across multiple time frames like you would with regular divergences. At this point, you're looking for regular divergences because that's typically what happens, right? Like on the 12-minute time frame, this will be considered a downtrend. So you're looking for something like this, which is your regular bullish divergence. Okay, this is very important. I know I'm saying regular and hidden a lot, and it might be confusing for you guys. Go back and watch it again. But it's a very important concept for you to understand. So hidden bull divs are better on higher term time frames. Okay, I don't even look for hidden bull divs on the lower term time frames because when the lower term time frames move happen, you're looking for regular divergences. You're not looking for hidden divs. Typically. All right, remember the trampoline rule. You have more time to bounce, and a higher bounce, the lower it goes. Now, how does this relate to our cheat sheet entry? Well, I mean, in theory, this is kind of one part of it, right? The cheat sheet entry is price comes and retraces to the 50 EMA, gobbles up the vector. Well, actually, it would leave vectors on the way down, hits the 50 EMA, and gives you a nice hidden bull div. So this is our low, which means this is our low, this dot. So we would have to do something like this. That's what you're looking for. Okay? Another thing to note, aside from the time, how the higher term time frames give you more divergent or better entries and it's more accurate. Another thing to note is that unlike your regular divergences, your hidden bull divs typically will not give you multiple divergences in a row. All right? For regular divergences, we can see something like this. It's not uncommon to see this. You're not going to see that with hidden divs. It's not going to happen. So, hidden divergences, you're looking at higher term time frames and you're looking for one. You can find hidden divergences in money flow. You can find hidden divergences in the momentum waves, in the VWAP, and in the RSI. And the more hidden divs you have, the better. But you're looking for them on the higher term time frames. Now, that's for trend continuation, right? As we know, the market will always be doing some kind of trend. At some point, it's always going to go up or it's always going to come down. It's never literally going to be flatlined, ever. Okay? Now, I find that hidden bullish divergences are not as strong as regular divergences. What do I mean by that? If this happens, my example that I've drawn and for some reason deleted a few times, if this happens, we can expect the price to come up, right? The next, however, if this happens right after, where we have a regular divergence, cut the trade. Cut the trade and look for a new entry if needed. Obviously, if money flow is increasing, you can expect a third divergence, something like that to happen. But your regular divergences are stronger, in my opinion, than your hidden divergences. So don't get in on a hidden divergence and think, oh, I'm good, we're going to 100K. It might, but it's probably not going to do that. So as soon as you get into a hidden are you joking me? As soon as you get into a hidden divergence trade, as soon as you see a regular bearish divergence, I know I'm going back and forth with these terms, you got to be aware, right? You got to be aware. Here we're on the 1 hour time frame. This can very easily give us something like this, which it probably will. Come back down, recover these green vector candles. This will come back down, make a lower low, give us a nice hidden divergence. Even if it comes down this low, that's even better, right? Gives us a nice hidden divergence and then continue to move up. This is probably something that's likely to happen. This is how you use your hidden divergence. This is how you can find trend continuations, okay? If you don't see a hidden divergence on the time frame that you're trading, oh my, are you joking me? If you don't see the hidden divergence on the time frame that there's no way. On the time frame that you're trading, you can move to higher term time frames until you see one. Okay, so if you normally trade the 1 hour and it fails, you can jump to the 2 and look for it there. And then if that fails, jump to the 3, etc. All right? But keep in mind, again, you're looking on the higher term time frames for these hidden divergences. And then what you can do is you can come onto your executional time frame and look for regular divergences. And when you see something like, let's just say this was one. We don't have a good example right now, sadly, but let's just say this was one. You'd put the stop loss under the low and happy sailing. There you go. Run it up until you see the next bear div, right? If you're on the 2 hour and you're executing on the 15, then you look for the bear div on the 15. Look at this right now. Money flow is coming down over time or staying the same, let's just say. However, the price is getting higher. So what's to stop price from doing something like this, giving us the div, giving us one more move up, and then our div, and then coming back down? Look at the 2 hour, right? We have these vectors. So we look for bear divs on the lower term time frame. Price comes down, doesn't take our low. However, we put in a lower low on the oscillator, only to ride it back up. This is what you need to do. You need to flip back and forth in your mind from bull div to hidden bull div. From bear div to hidden bull div. Bear div, hidden bull div, or bull div to hidden bear div. That's how you got to think about it. The higher it is, the higher the wave, the more of a drop, the more room it has to go down. The higher the jump off the trampoline, the higher bounce it can go. So the lower the wave is, the better it is. And the bigger the divergence, the better it is. If this comes all the way down here, which I don't even think is possible, but price only just does that, this is a huge hidden bull div. This is a very strong signal because look at all the time and all the space it has to rise. Wow, I am really not doing well with my trading view today. It has like so much to go. This is how you're going to use hidden divergences to find continuations. And remember, as soon as you get your continuation and you're in your trade, you're automatically flipping to how can you get out of the trade, right? You're going to start looking for bear divs. Once you're in a bear div, if you're in an overall macro uptrend, you're starting to look for hidden bull divs again or regular bull divs. But you need to flip your bias back and forth. Guys, if you don't understand anything, please ask me questions. Leave a comment down below or join the Discord. We have over 200 people in there. We're talking all day long. We got really good traders and we got new traders like you. So make sure you check it out. And I'll see you guys in there. I'll see you in the next one. Peace!